Thank you everyone for tuning into our quarterly update, looking back at the third quarter of 2020 and ahead to Q4 and beyond. In addition to our normal look at the economy and the markets, I'll also briefly discuss our thoughts around the election. As we reviewed last quarter, the rebound in activity we've seen was no surprise as the economy reopened to varying degrees across the country. And this is clearly seen in both the ISM manufacturing as well as non-manufacturing surveys. I do want to reiterate again, these numbers capture month-to-month changes, and these charts do not represent an economy fully recovered. For one, unemployment remains elevated, as seen on the chart of continuing unemployment claims. However, it has recovered significantly from the worst levels, as many employees have begun returning to work. Another concerning signal is the continuing uptick in permanent job losses, seen on the chart here. Additionally, will the job losses begin to impact higher income individuals whose consumption would most assuredly decrease as unemployment benefits, increased or not from the federal government, would not replace their lost income? With further government support yet to materialize, we're left with the same conundrum from last quarter, namely an economy that remains structurally weak, but markets that are kept at bay with the promise of fiscal support. Meanwhile, what damage is being done to the overall economy, particularly smaller businesses, in the absence of further support? Turning now to the markets, equities continued their rally in the third quarter. As you can see on the chart on your screen here, the S&P 500 and emerging markets were both up over 8%, and developed international, as represented by the MSCI EFA, and small cap stocks, as represented by the Russell 2000, were both up over 4%. However, as you can see on the chart, we did hit the pause button to start the month of September, which we'll speak to a bit more later. As we've discussed on prior calls, the concentration of the market into the mega cap growth names has had a disproportionate impact on the returns of many of the broader indexes. The next two charts illustrate that point. So the first chart here on the top portion is just a chart of the S&P 500 going back to 1980. But the bottom section represents the concentration of the market. So it's what percentage of the total S&P 500 market cap are the top 5 stocks at any given time. And as you can see, currently, we're at the most concentrated we've been over that 40-year time period at almost 22%. This chart was through August 19th of this year. And the next chart shows that in another way. This chart also goes through kind of the beginning to middle part of August, but the point still stands, where the big 5 names, Facebook, Amazon, Apple, Microsoft, and Alphabet, versus the other 495 stocks. So those big 5 names were up almost 35% through that time period, versus the other 495 stocks were actually still negative on the year. But that left the S&P, given the concentration, up 3% over that time period. So the dollar served as an additional tailwind for asset prices, declining 3.6% for the quarter. However, it did close off the lows, which may have played a part in the market weakness we saw in September. As you can see on the chart, we were down almost 5%, a couple times through the month of August before rallying a little over 2% off the lows into the highs of September, which again, that may have been one of the catalysts for the weakness we saw in asset prices broadly for September. The weakness in the dollar also helped propel gold to new all-time highs. You can see on the chart here, we actually eclipsed $2,000 an ounce in gold before settling into 1887 roughly at the end of the quarter, again on the backs of the strength of the dollar that we saw for the month of September. Right, on to the election. So we recently had Libby Cantrell, who's the head of public policy from one of our third-party partners, PIMCO, on our recent monthly investment committee call. So I borrowed a few of her slides here. The first slide is around the fiscal spending outlook. So you can see here, they view spending as a given. It's just a matter of where that spending will be directed. For example, on the top, both candidates are looking at large infrastructure bills. Were the Democrats to win, that would have more of a Green New Deal look to it, prioritizing climate concerns and more renewable energy sources. But again, regardless of the outcome, both candidates are likely to spend a lot of money. And a big part of that, as seen in the slide here, is this notion that deficits and debt don't seem to matter anymore. And my personal view is that policymakers may likely test that view to its absolute limits in the years to come. And then lastly, so regardless of one's thoughts around President Trump, he has been incredibly successful in changing the narrative around China. So the two charts on your screen here show on the left-hand side the percentage of Americans in total who have an unfavorable opinion of China. And then on the right-hand side, it's broken down by political affiliation. So you can see Republicans tend to have a higher unfavorable view of China than Democrats, but this is very much a bipartisan issue. So while volatility around the election is likely, we think it's prudent to focus on the longer term. Both of these potential trends, deficit spending as well as further deterioration in relations with China, may come to pass regardless of the election outcome. Both of these trends are supportive of our concerns around inflation and the potential for currency debasement. So we continue to focus on ways to help our clients manage these risks. All right, so I want to thank everyone for joining. And as always, your advisors and the Investment Strategy Committee are here to help in any way we can.